Good morning. Unlock capital and grow operations. How sale-leaseback strategies empower business owners. In today's commercial real estate environment, especially for business owners, owner-occupiers, as well as investors, the right structure can unlock value, improve liquidity, and set the stage for growth. One of the most underutilized but highly strategic moves is the sale-leaseback. And when properly executed, the sale leaseback strategy can transform real estate assets into business fuel while preserving operational control. So you may be asking, what is a sale leaseback? Well, a sale leaseback occurs when a business owner sells a property, typically the real estate they own and occupy their business from, to a third party investor and simultaneously signs a long term lease to remain on the premises. In essence, you shift from being the owner to being a tenant while freeing up the equity in your real estate. So, for a business owner in Houston or nationally, that means converting a fixed, illiquid real estate asset into deployable capital while keeping your location, your operations, and your team intact. So, why business owners and CRE investors should pay attention? So, for business owners, you can unlock hidden equity. Your real estate may have appreciated significantly, and selling it allows you to access that value now at today's prices. You can reinvest for growth. So the proceeds from a sale leaseback can be deployed into higher return opportunities, new equipment, market expansion, new technology, or just debt reduction. You can improve your balance sheet flexibility. Instead of carrying real estate assets and associated liabilities, you can convert that into a lease expense and strengthen your debt metrics. And all the while, you retain operational continuity. You remain in the space so business disruption is minimized. And that is a key benefit compared to relocating or selling and then having to vacate the building. So for CRE investors, predictable long-term cash flows when structured with creditworthy operating tenants and long leases, think 10 to 20 years, triple net structure, these assets become stabilized investment plays. So you have dual collateral, both the tenant and the property. The investor holds both the property and the lease with a strong tenant, which can enhance risk-adjusted returns. So some key strategic considerations for business owners. Well, before jumping in, business owners should evaluate a few things. And the first question is the real estate core to your business, or is it a non-core item? And if property ownership is not central to your value creation, for instance, you're a manufacturing business, not a landlord, monetizing that asset could make sense for you. Lease terms matter. So ensure that the leaseback is long enough to secure your operations and that escalation terms or renewal options and tenant improvements are aligned with your business life cycle. So there could be tax and accounting implications, and lease payments are typically fully deductible as a business expense, which can be more favorable than owning and depreciating the real estate yourself. But you'll want to work with your CPA to handle the sale gain, any lease liabilities, and any balance sheet changes. So market timing and valuations. The best returns come when real estate asset values are strong. And when the business can redeploy the capital at a higher return than the real estate is yielding currently. So partnering with the right investor or landlord, you'll want a landlord who is aligned with your operational needs, supports your expansion or upgrades, and allows flexibility for your business growth. As noted, you retain control of real estate through a triple net lease. So your business has full control of the real estate through your leasehold rights. So how do we structure a powerful sale leaseback? Well, here's a step-by-step outline tailored for commercial property owners, investors, as well as business operators. Step number one, property valuation and a real estate audit. So you review your own facility, your location, its condition, the value appreciation, and your lease status, if any, and how core the space is to your operations. Step two, financial modeling. So model scenarios where you sell the property, lease it back, and redeploy the proceeds into your business or investment. Compare projected returns, tax benefits, and balance sheet improvements. And step number three, Lease negotiation. So as you negotiate the sale, ensure the leaseback has a length that's suitable. Think 10 to 20 years. Look at rent escalations, options to renew, and ability to expand or contract space if needed. And clear responsibility for improvements or maintenance are a must. So, step number 4, legal and tax due diligence. Work with your attorneys and tax advisors to ensure the transaction qualifies as a sale under accounting rules. Identify any transfer taxes, evaluate the lease for off balance sheet treatment, and also confirm the tax deductibility of rent. Step 5, deployment of your proceeds. Decide how you'll use the cash, whether it's paying down debt, funding expansion, or investing in higher return business lines, or just simply accumulating a reserve. The goal is to turn that real estate equity into strategic growth. So, in step 6 is investor buyer selection. Your property buyer landlord, you may want to vet them, see if they're aligned with your business needs, and if they have experience in triple net leases. And also, are they willing to support your business through the lease term? Step number 7, ongoing asset and lease management. After closing, treat your new tenant relationship and lease management like you would any other critical contract. Monitor your lease obligations, renewal options, and property conditions to avoid surprises. So here's a real world scenario and some use cases. A doctor owner who owns a dental clinic, who owns the building, might execute a sale leaseback to unlock new capital for equipment or expanding into another location or hiring additional practitioners, whatever it needs to make your business grow. Now, a manufacturing business in Houston that owns its own warehouse and distribution facility could sell the property and lease it back to reinvest in automation, digital operations, or new markets. Some food for thought. CRE investors looking for stable income streams might also partner with operating businesses for sale leasebacks. Basically, you're targeting strong tenants, long leases, and triple net structures. So here are some pros and cons at a glance. Look at the benefit and the trade-off or the risk. So it's an immediate cash infusion, improved liquidity, and you give up property ownership and the upside appreciation. But you get fully deductible lease payments for your business, and you commit to lease obligations long term. Businesses may need to change around those structures. So focus on operations versus landlording. You become a tenant, less control than owning, but also attractive for exit or growth strategy. Market downward shifts could reduce property value, and though you've already crystallized your gains, so that could be an upside. Improves financial metrics, debt capacity, and you need to ensure lease terms and the investor are aligned with your needs. So why this matters in 2025 for Houston and beyond. So interest rates remain elevated, which makes traditional debt financing more expensive. Real estate values in many Texas markets, including the Houston area, present unique opportunities to monetize assets. And a well-structured sale leaseback allows businesses and occupiers to leverage their real estate while staying in place and continuing their operations. For CRE professionals, investors, and business owners, operators, in Houston, Katy, Fulshire, and the broader West Houston corridor, this means you can craft creative strategies combining property, operations, and capital deployment. So here are the final thoughts. If you're a business owner who owns your facility, or you're working with one as an investor, CPA, lender, or broker, the sale leaseback strategy should be on your radar. It's not just a transaction, it's a strategic move, and it allows you to free up capital that was previously locked in your real estate. It allows you to redeploy that capital into your core business or higher return opportunities. And this still allows you to retain control of your operations and location via the leaseback. Simply put, it improves your financial flexibility and prepares for growth, exit, or transformation. And at Viking Enterprise Team at eXp Commercial, we specialize in aligning businesses, real estate, and capital strategies for owners, investors, and developers. And if you'd like to explore whether a sale leaseback is right for you or your client, drop us a line. Let's unlock your real estate value and fuel your next chapter. Thanks for your time. That's it for the day.